Hello everybody, and thank you for watching this video. In this video, we're going to be going over budgeting. Um, Budgeting is extremely important. It's also, it can be difficult. I think I'm trying to present it in a way that is not difficult to understand. But it's really important because, as you'll find out, budgeting is how we set goals and monitor our performance based on those financial goals over the course of an operating year. Okay. Um, from my experience in industry, we're given a master budget, which we'll talk about, and then we break that budget down per quarter, per month, and then per week, in order to see if we're meeting targets or if we're not meeting targets, and what we can do to improve the organization or at least meet the organizational goals. Well, based on my experience, typically our budget for an upcoming year is really dictated by the previous results that we've had. In fact, our head office was accustomed to basically giving us last year's operating results. So basically, our income statements and our balance sheets, and their approach to budgeting was just make it better than, like, be better this year than last year. You don't have to be X amount better. You just have to be better. But that doesn't quite show us how to budget for different scenarios. For example, startups, how do we forecast sales when we don't have any, or we don't have a sales history, right? So we're going to be going over that today. We're going to be employing, two kinds of budgeting. It's kind of like a combination of top down and bottom up. But I think it's fairly straightforward and much more useful when you don't have that previous operating history or financial history. That said, near the end of the lecture, I will show you different techniques for forecasting sales into the future based on previous results. So here are some of our learning objectives for this part of the week. We're going to understand what budgeting is, and we're going to describe the three purposes of budgeting. We're going to describe the different kinds of budgets, and we're going to list the advantages and disadvantages of budgeting. We're going to list the 5 steps in budgeting. There are some steps, and we're going to understand what information is used to prepare budget. We're going to define zero-based budgeting and why it's useful in food service. We're then going to compute variances based on actual results to compare our current performance to the budget. Okay, and then at the end, I'm going to again discuss the relevance of regression analysis and moving averages to forecast sales and prepare a budget. So what is budgeting? Okay, or what is a budget? A budget is a financial expression of management goals. It usually comes in the form of an income statement. Okay, in fact, it looks pretty much identical to an income statement. It's just called the budget. The reason for that is because income statements and budgets, they report the exact same information, except that income statements are about previous financial performance and budgets are anticipated or forecasted financial performance. Just like on the income statement, your sales equals your cost plus your profit, or by an extension, your profit equals your sales minus your costs. The exact same logic governs the foundation and the construction of a budget. Okay, so in that, budgeted sales equals budgeted costs plus budgeted profit, but also budgeted profit equals budgeted sales minus budgeted costs. Okay, so essentially, when we're preparing a budget, okay, we're bringing together 3 unknowns, and those 3 unknowns are right here. Okay, I'm just gonna get my pen out. We have to figure out what our sales are going to be. Okay, based on those sales, we got to figure out what our costs are going to be, and then what the result is on our profit. Okay, typically there's 2 ways to do budgeting. One where you start with your sales, and then everything is based on your sales. Okay, on the other hand, you can also start with your profit, or what you want to make in that operating year, which then can be calculated almost backwards to derive your cost figures, and then based on some math, you get at your sales. Okay, both ways, I mean, they will produce different results in terms of what the budget actually looks like, but both ways are accepted. Okay, so what we're doing today is essentially we're going to be kind of doing a little bit of both. Okay, so we're going to we want to be able to forecast sales firstly, which is going to dictate a lot of our variable costs because most food service businesses they have low operational leverage, which means they have higher variable costs, and these are all proportional to sales. So we're going to take our sales budget or our sales forecast, and we're going to calculate our variable costs. Our Then we're going to use zero-based budgeting and identify our fixed or indirect costs, and then our profit. Okay, we can always make changes to the budget after we've created, a draft of one, right? For example, if we were to create a budget and find that our profit is going to be too low, we could make changes to the budget in order to increase profit. Okay, but doing this method allows us to forecast sales relatively accurately, dictate costs, and then tweak it a bit later. Okay, but again, sorry, just one second here. The budget is very simply just an income statement that's projected into the future and is a financial representation of management's goals for a business. Generally speaking, there's three purposes for budgets or for budgeting. First of which is to propose an organized estimate of activity. Okay, if we understand that all sales are created by activities, but those activities also create costs. If we know the estimated sales activity that we are going to be facing in the future, we can align costs to produce or at least be successful at that level of sales activity. Okay, essentially what this does, if we know what our sales are going to be, right, for any particular month or day or whatever, that can help us plan our labor cost and our food cost for those particular periods, right? So for example, if I know if I'm forecasting on one day to be busier than another, I know to put more labor on the day that is busier, right? So I can allocate costs easier, right? So this has implications into ordering food, also scheduling. Okay, so putting some parameters or helping us estimate the level of activity needed from some of our big variable costs. But that's not the only purpose of a budget. It also helps us as managers or as owners understand our short and long-term goals, right? We're going to create one budget, but that budget is going to have implications on, on a monthly basis. It's also going to have implications to what we're doing on a daily basis. Okay, so it helps provide, light or the way forward to achieve a specific goal, right? Like at the end of the day, we want to make profit. Okay, in order for us to make that profit, we know that we have to sell a certain amount per day, and based on that, we can do things like I just said, plan our labor and other costs, but it also provides managers with those goals. This is what I need to achieve in order to realize the budgeted amount of profit. On the other hand, and the last purpose of a budget is to provide information to managers for control, right? We don't just prepare a budget and leave it, right? We look at the budget and we compare it with the actual results in order to find out where we can be making some improvements in order to meet our budgeted goals. So whether that's a cost, so if our cost is higher than it should be, we have to look and understand where we can make improvements so that we can get that cost down and still realize our long-term goal or even our short-term goal. And even with sales, you know what I mean? If sales are not as high as we were anticipating, there are some things that we can look at to improve sales. But also, in some cases, make changes to the budget. If the budget is unreasonable, we can make changes on the fly to have it, be more realistic, right? A budget that's not realistic is not a very good budget, right? And in our industry, sales go up and down so often, and there's so many extenuating circumstances that will affect our sales. So we also need to control our budget or make changes to it as we progress through the operating period, which is usually 1 year, in order for our budget to be accurate. Right? We want to get to the end of the operating year and our actual profit be relatively similar to our budgeted profit. Okay? So here's where we're going to talk about the different kinds of budgets that are available to us or that we can create within food service. Some are more applicable than others, as you'll see. But based on my industry experience, we use a combination of some of these types of budgets. We'll talk about that in a second. Firstly, long and short-term budgets are budgets that cover different periods of time. For example, short-term budgets usually exist within one operating year, okay, or even broken down per month or per day, whereas more long-term budgets cover multiple years, okay, and these budgets can apply to different other contexts. For example, departmental budgets or operating budgets can be more short term, okay, whereas capital budgets or capital expenditure budgets, which concern themselves with decisions that are more long term, so more than a year, okay, so anywhere from 5 to 10 to 15 years would be more considered to be a long term budget. Okay, so we can classify budgets based on the time span that they cover. Okay, we also have fixed and variable budgets. Okay, fixed budgets are prepared for one level of sales activity. Okay, and they don't change. Okay, usually these budgets are used in industries that are pretty stable and not volatile. Okay. However, there are also variable budgets, which are those budgets that are prepared for different kinds of sales activities. For example, 5, 10, or 15% sales growth forecasts, or even changes as they happen. So a variable budget can take into consideration if your budget does not take into consideration, a competitor that just opened up, within like a kilometer of you, obviously that's going to affect your sales. You could adjust that in your variable budget, okay, but you wouldn't be able to do that with a fixed budget. Okay, so using variable budgets, we can change them as we go based on new information that we have. As a result of this, variable budgets are typically understood as best practice within our industry. Okay, the reason why we would want a variable budget is so that we can change aspects of it to more closely reflect our, the current ongoings within our industry, or that's facing our business. And if we understand that, costs or different levels of costs and sales will affect our profit, think back to CVP, we need to do this in order to have our budget be accurate. Okay. So yeah, typically speaking in our industry, we do employ variable budgets, but that's not the only kind of budget we use, and I'll talk about more of those in just a second on the next slide. So more kinds of budgets. We have a capital budget or a capital expenditure budget. Okay, so this is a budget that plans for replacing or acquiring fixed assets in the future. Okay, it's basically a plan or a financial plan to replace or buy new equipment in the future, so that when the time comes and your equipment is no longer useful, it's at the end of its useful life, we have money put in place or a budget put in place to replace that piece of equipment. Okay, so for example, you could have a 10-year financial plan to renovate a restaurant. Okay, where a portion of your net income is reserved and budgeted for that renovation. Okay. We also have operating budgets. So these are budgets that are broken down in terms of a month, week, or even a day to help management understand what their daily, weekly, or monthly goals are. Okay, and what their sales should be on any specific kind of day, and what those costs should be. Okay, so they can monitor their own performance. We also have departmental budgets or department budgets. These are budgets that are simply broken down in, like, it's one budget that's broken down into several different departments. Okay, the assumption here is that these different departments all contribute towards creating sales for the entire business. But as restaurants or in most food services, we don't have different departments necessarily. I mean, we can have catering and retail, and we can prepare a budget for that department. Um, However, we don't typically create department budgets just because we don't normally have different departments. Okay. Um, while our in industry, best practice is to use a variable budget that we can change and have it more accurately reflect the competitive environment that we're operating within. We also use operating budgets. So we take that budget, that variable budget, and we break it down per month, week, and even day to help us understand some of the benchmarks that we should be hitting. For example, on Monday, if I'm supposed to sell, $5,000, that that gives me an indication of what kind of labor I should be using. We could even break it down per hour, and if I'm being honest, that's what we do. Not necessarily a budget, but some of the targets that we're supposed to hit. For example, a daily budget will tell you, or can tell you, how many guests you're serving per hour, okay, and how many labor hours you should be using per hour, okay, based on that forecasted amount of guests. And if you were to find that the amount of guests that you're serving is less than that target guest count, you have to make sure to change your hours used, okay, to keep with your budget, okay, which is actually a bit more difficult than it sounds because labor laws, you can't just, if someone comes into work, you know what I mean, and just because 1 hour is slower than you were anticipating, you can't just send people home, right? You have to pay them for at least 3 hours. So flexing and trying to make changes to your costs when you're finding that you're not hitting your sales budget for any particular day can be difficult just because of some of the laws that we have. And I mean, rightfully so, but again, it is nonetheless still difficult. So again, if we're trying to create a picture of what kind of budget we should be using and creating within food service, at this point, the budget should be variable so that we can change it. Okay, and it should be broken down into operating times. So, for example, days, weeks, and months to help us understand exactly what our financial goals are, and so that we can control the costs within those particular time periods. All right, the last kind of budget. Okay, and it's still relevant to food service. The master budget is a budget that is comprehensive. Okay, so comprehensive in terms of it represents our sales, costs, and profit from all operating departments for typically a year. Okay, and then we take this master budget and then we can break it down into operating periods. So again, weekly, monthly, and daily operating budgets, and it also gives us crucial information that can be used to achieve long-term goals, because it has if the master budget is a representation of that long-term goal in terms of a year, right? And then we break that down into smaller goals, if you will. That's daily goals, weekly goals, monthly goals through operating budgets. But our master budget should always still be flexible enough that we can change it to more accurately represent the competitive environment that we're operating within. One example that I had is I went to work at a restaurant, and we had a movie theater in the plaza. Okay, so it was big. I believe it was AMC. I forget, but it was big. Okay, and usually that's where we got like quite a bit of our late night guests from, and even our like 8 o'clock guests, right? People going to see the 9 o'clock show. Um, that the, we prepared our master budget, and as a result, our operating budgets, um, based on not knowing that theater was going to close down, right? As that theater closed down, okay, we had to make a change to the budget because we were not going to get the same draw that we had before, because there was no theater there. People came to watch a movie, and as a byproduct of going to see a movie, they had dinner at our restaurant, right? Because that theater wasn't there anymore. They didn't come to our restaurant. So we knew that our sales were going to be hit very heavily, in terms, like, our sales were going to go down, right? So we had to have a variable budget so that we could change our sales level, and as a result our costs, because most of them are proportionate to sales because they're variable. And then we could more effectively understand what the result on our profit was going to be. Okay. If we didn't do that and we couldn't change our master budget because it was fixed, then we would have continuously shown poor results when compared to budget. Okay, and that's what we do with budgets is we take our actual results and we compare them to our operating budgets and thus our master budget, and we see how well we're doing, right? If we're not hitting our budget targets, that's not a good thing, right? Because if we're not hitting our budgeted sales or our budgeted costs, then that's negatively affecting our profit or our financial goal for that year. So again, for in food service, we need to create a variable master budget that is broken down into several operating budgets. So that's monthly, weekly, and daily operating budgets. And that's typically seen as a good control and good practices with respect to budgeting. So who's responsible for budgeting? Okay, so in corporate environments, so like head offices for restaurants, if it's a franchise, any other kind of corporate atmosphere, manufacturing, retail, things like that, it's usually accountants or the accounting department that produces a budget. Okay, and they do this with participation and information from departmental managers. Okay, and doing this, it provides a holistic view or a comprehensive view of the organization from the people who are responsible for managing it, right? So let's say in manufacturing, I was from the car manufacturing department, okay? I would tell the accounting department what I expect to happen within my department. So how many cars I'm going to sell, how many I'm going to produce, what it's going to cost to do that, and what my departmental profit's going to be. And then I send that to the accountant, and they create their master budget. Okay, we can do the same thing in our industry, and I've seen it done before where what would happen would each restaurant within a franchise or within a chain, what we would do is we prepare our own budget for our own restaurant, and then we send that to the accounting department, and it would be scrutinized, and they would change it into what they want anyway. So we did have some say, but I don't know. For some reason, our brand was not doing very well. I think we were averaging like 10% down year over year, so our sales were going down 10%. And they stopped creating budgets. They just said your budget for the upcoming year is your operating results, like your actual results from the previous year. And again, their direction was just be better than last year. Okay, so excuse me. I'm not sure that that's the best way to do it. However, they did create a master budget for us, and then based on that master budget, we got our restaurant budget that we turned into operating budgets. So budget for the month, for the week, and for the day, if you will. But we did not necessarily have the ability to change it. Okay, so that was a head office type thing. So in terms of who's responsible for budgeting, as a restaurant, as an owner or as a general manager or as a chef, it's typically your responsibility. Okay. The idea is that if you're an owner, you're creating the budget so you understand what kind of money you're going to be receiving at the end of the year, what your costs are going to be, what your tax obligations are going to be. And upon reflection, we really didn't have much of a variable budget, but we did, based on some indirect costs, have some flexibility in terms of making that our actual results look better than they were. So, for example, in a month, right? If my sales were not so good, or sorry, we'll do this example in terms of a week, right? So, if I knew that for an upcoming week, my sales were not going to be nearly as good as I thought they were going to be, based on last year's results, I can do some things to kind of change the results, right? So if, for example, if I've got $1,000 or $2,000 budgeted for that week, and I knew that sales were not going to be as high, I can just not train anybody. Okay, and then by not training anybody, I'm not incurring that $2,000 worth of training expense, and I can make the budget or make the actual results look a little bit better than they would have. Okay, so again, to kind of tie all this stuff in together. You are responsible as a business owner or a general manager or a chef for creating a budget. Okay, and this budget should be derived from a master budget and then broken down into operating periods such as a month, week, or day, and it should be variable, so flexible enough so that you can make changes to the budget as you progress through the year that more accurately reflects your the competitive environment. Okay, so when are budgets prepared? Okay, very simply, budgets again are expressions of financial goals into the future. So as a result of that, budgets should be prepared at least prior to the period that they encompass or that they cover, right? So, for example, if I'm making the budget for 2021, which is next year, I need to have that budget completed before 2021. Okay. However, budgeting takes time because the idea here is not just to put together a document that you know um, that you think is what to expect of the future without any evidence or any reason, right? So that could be bad, right? We need to make sure that the budget is accurate and takes into consideration various kinds of information. As a result of this, budgets should be prepared 4 months prior to the year that they cover because it's been identified that that's the amount of time that you're going to need to make an actual accurate reflection of the future. Okay. Long-term budgets, on the other hand, should be prepared well in advance before a business is opened and should be maintained as operations begin. Okay, so one of the criticisms, I was helping a gentleman recently purchase a business, and it looked pretty good. I thought the numbers looked really like I thought well, all the numbers were there, but when going to get financing, the investors um, they wanted to know what his long-term budgets look like. So that's capital expenditure, cash flow or stuff like that. And because those budgets were not in place before he purchased the business, they said, no, we can't give you financing until we have your long-term budgets. Okay, because these need to be put into place before the business is either opened or purchased. Okay, so in that case, we went back and created a capital budget. um, in budgeting, it's useful to start with your sales forecast. And once you know your sales forecast, it will typically dictate what your costs are going to be, because most of the costs in food service are variable or proportionate to sales. So as long as we know generally the cost structure of our business, we can allocate costs based on sales level, and then our sales minus our budgeted costs, that'll tell us what our profit is going to be. Okay, and that's again what our goal is. But um, very generally speaking, good rules of thumb is that accurate budgeting takes at least 4 months, and long-term budgets need to be prepared well in advance to a business either being opened or purchased. So here's where we're going to talk about some of the advantages of budgeting or creating budgets, right? If we understand this is going to be time consuming and, uh, as accurate as we try to make it, it's never quite 100% accurate. It There are some limitations, but the advantages, in my opinion, far outweigh the disadvantages. Now, in order to understand the advantages of budgeting, we have to remember that activities or behaviors produce sales for our organization, but that these activities also consume resources, right? In budgeting, we're essentially aligning those activities to the sales level that we are anticipating, okay? Because those activities help create dishes, help serve guests, and things like that. But those activities consume resources. So they create costs. So we have to know how these activities are going to create costs. So the advantages to budgeting is that these activities or activity level helps us do a couple of things. Okay. So I'm just there we go. One is create schedules. Okay. Firstly, if we know how many guests we're going to serve over the course of a week, and even per day, we can calculate the amount of hours we're going to need to serve that amount of guests. Okay. We can also know how much product to purchase, right? If we know that for a particular month our cost of goods sold is going to be $5,000, we need to know that we have at least, based on our inventory turnaround, we need to have at least $5,000 worth of inventory on hand at any time, or at least have the money to purchase the product to build it up to 5,000. Okay. Advertising, right? If we know that our sales level is not going to be as high as we want it to be. Okay, so let's say we forecast our sales and we're like, oh, well, it'd be nice if we were generating more sales this year, then we could allocate some advertising in order to produce that sales level. Okay. Sales levels also have implications into production quantities. Okay, so how many logs of PR you're cooking per day, how many portions based on a sales mix you need to create and prep for any particular day or week. Okay. It also has implications in hiring needs. For example, if we know we're going to be busier than last year, we may need to hire more people, right? If our schedules are a bit stretched and people are getting one day off a week, which nobody likes, then we obviously need to hire some people, right? So there's a ton of advantages to budgeting, and most of those advantages are about helping us understand what kind of activities we need to align for any particular day, week, or month in order to produce the anticipated level of sales. Okay. But there are some limitations, which we are going to talk about in the next slide. Okay, so here are some disadvantages of budgeting. Some of them are pretty straightforward. For example, one is it takes a long time to do accurately. Like I had mentioned, 4 months worth of planning. And us as food service managers or chefs, we know that we don't have a whole lot of time to just sit down and play around with the budget. So this can be time consuming, and again, time is not always a resource that we have lots of, right? There can also be unknown factors that are going to affect our budgets in many ways that are largely unpredictable. For example, my previous experience with the theater closing, right? That was completely unpredictable, but it did affect my budgets in many ways. However, because I had a variable budget, some of this disadvantage was limited because I could change my budget. Okay, some budgets may include confidential information. Okay, for example, salaries, wages and stuff like that. And if your budget includes that information, it's no longer confidential, right? One year, what is it called? They announced that there was going to be no bonuses for the management team. However, we were still budgeting for, it was like roughly like $1,000 a month for bonuses for the end of the year. So the confidential information here was that some people were getting budget bonuses where other people weren't, right? So the company said we're not doing bonuses, but it was still being budgeted for, so somebody was getting that money, right? So that was kind of confidential, but because it was included in the budget, it wasn't necessarily confidential anymore. Sometimes, well, this is the main disadvantage of budgeting. It's called spending to the budget, right? So one of my general managers, like this was when I was a young manager, what he would do, he had a busy store, so he had a busy restaurant, right? And what he would do, even if he was going to come in at the end of the month in a really good spot, so his sales were up and his costs were down, he would still spend to his budget. So basically, if his budget for something, okay, if his budget for the wage cost was $1,000 and he only spent $750, he would spend the extra $250 to meet the budget. And the reason why he did this and his justification for it was that if you don't spend it, you lose it. So basically, if you're not spending to the budget, next year you're going to get a lower budget with tougher goals, right? Because again, even cost percentages are a goal that you need to hit, right? So spending to the budget can be a disadvantage, but as long as there's some kind of incentive for a management team not to do that, then it completely gets rid of this disadvantage, right? So for chefs, A lot of a chef's bonus structure is created by, if looking at food cost, right? So if the budgeted food cost percentage is 30% and you have a 28% food cost, that's lower than budget, and you get a percentage, or you get some money from that savings. So basically they're incentivizing, beating the budget or being better than the budget. Okay, without that incentive, there's no incentive to be better, right? So because management teams don't want to lose that budgeted finance, or that money, they just spend to the budget. Okay. Well, these are all disadvantages of budgets, okay, and most of them I think are fairly straightforward. Um, again, the advantages are just so much better than the disadvantages, right? Um, it's easier to control costs. It's easier to create schedules. It's easier to understand if you need to hire, what kind of working capital you're going to need, things like that. And this just helps us plan our daily activities a lot better. Okay, so despite all these advantages, I still believe that budgeting, and we should be budgeting in our industry. That said, there's quite a few restaurants, especially within Georgetown College, that don't budget very well. Um, not within our particular department, but some other department I can't speak of. They don't budget very well, but you still need to budget because it helps you understand what you need to do in order to achieve your financial goal. And as a business owner, that is your money at the end of the day. That is your return on investment. So what does the budgeting process look like? Okay, well, first of all, it's a cycle. Okay, where you begin a cycle, and then the end of the cycle is the beginning of a new cycle. So it's just a continuous cycle that you do pretty much every single year. Okay, and this cycle, the process, starts by establishing or understanding what your goals are in terms of finance. Okay, so what are your financial goals for the restaurant? Okay, excuse me. You then plan to achieve them, okay, by aligning cost items, which are the cost of activities, with the sales that they produce. Okay, so that's once we understand what we want our profit to be, we can do a quick CVP analysis. It's going to tell us what our sales and volume needs to be based on cost percentages. Again, because we have primarily variable costs, we can align cost items, so food cost, beverage costs, wages, things like that. We can calculate the cost of those items based on the sales activity, right? Once we've created the budget, so that's pretty much what the budget is. So we've planned for sales based on a target profit or operating income. We then align our costs, which are primarily variable, okay, and those are based on sales. We show our fixed costs, which are going to be known and fixed. We've essentially created our budget, okay? But that's not where that we stop using the budget. We need to compare the actual results with the budget to understand any variances between what's actually happening and what we thought was going to happen. Okay. You then need to do an investigation by calculating those variances and take corrective action so that in the future you can meet your budgeted goals. Okay. It's important to do this or take corrective action because if we understand that problems are not good things, okay, problems also continue into the future if they're not fixed. Okay, so we need to fix them so that they do not continue and that we can meet our goals. Okay, and then going through the cycle, one of the last steps is to improve the effectiveness or the accuracy of your budget. Okay, so when you first create a budget, your very first budget at a restaurant or any kind of food service business, it is not going to be accurate. Okay, I say that with like 100% confidence. You only get better at forecasting or budgeting as you start to understand more about the business and how the competitive environment works. Okay, and as you understand those things more and get understand your financially understand your business on an intimate level, only then does your accuracy of the budget become better. Okay, and this only happens with time. Okay, and And yeah, and then the whole cycle starts again. You figure out what your financial objectives are for the year. You plan to achieve them by aligning cost activities. You compare to see where you're either doing well or you're not doing well. Take corrective actions to improve the budget, or improve performance in future periods. Then start the budgeting process all over again by improving your effectiveness or the accuracy of your budgeting. So starting a to create a budget, okay, you can do it two ways really. The first way, and I don't necessarily recommend the first way to start with, is doing a CVP analysis to understand the sales level needed to achieve an operating income after tax. Okay, so that's pretty much telling, you know, basically taking your fixed costs, adding the desired amount of profit, and then dividing it by your contribution rate. Now, there's some serious disadvantages in doing that. We call that bottom up budgeting. So we start with the bottom line and then budget upwards. The limitation of this is you're essentially telling the budget, or creating a budget based on a mathematical equation that doesn't necessarily take into a whole bunch of things. Okay, but the advantage of bottom-up budgeting is that in doing that kind of analysis, it tells you what your sales forecast is, and that's exactly where we want to start with our budget. Okay, and in this case, we're going to be doing a top-down budget where we start with our sales forecast. We're not going to do a CVP analysis because it doesn't take into consideration the 4 trends that I've listed here, or the 4 factors that I've listed here. So I'm going to show you a different way. Okay, although you can do a CVP analysis, it's a little bit one-sided. But it is important that our first step in creating a budget is that we have to set our sales forecast. This is because a lot of our costs will be dictated based on our sales forecast, because most of them are primarily variable, right? And then we can understand what our profit will be, and we can make some changes. Okay, for example, if we found out that our profit was not as high as we want it to be, we could do some advertising, right? And then by including that in the budget, we could justify an increase in the sales level. Okay, but neither here nor there. Sales forecast should be based on historical information. Okay, so that's previous sales. And also a few other factors. So one is anticipated trends. These are largely based on the past. Okay, so this is indexes or sales indexes. This is trend percentages. Okay, and we take those, or even rolling averages. Okay, I'm going to put that in here as well. Rolling averages that will help us anticipate whether our sales will be going up or down for the next year. Furthermore, we need to take into consideration economic factors, and these are things that may affect your cost. For example, increasing minimum wages, okay, increasing taxes, okay. These economic factors are going to have a tremendous impact on what our costs are going to be, so we need to take those into consideration. There's also competitive factors. Okay, so whether the competitive environment is becoming more saturated or less saturated, right? So if we have more competitors, it's not reasonable to assume that our sales are going to be as high as they were last year. Okay, so we need to take that into consideration. This one's fairly subjective in terms of like how we know that, okay, so if our industry is becoming more competitive, especially within the our operating area, we know that this is not going to positively affect our sales. But how do we take this into consideration? Like, is there a formula or some sort of calculation? Unfortunately, there's not. Okay, so you just need to make some sort of adjustment to your sales that reflects the competitive environment. Then we also have limiting factors. Okay, so this, in my example of the what's that called? The movie theater that closed down in the plaza that my restaurant was in, that had a severe limiting factor on my sales. So basically, it was something that happened that limited my ability to achieve my sales goal. Okay, so the movie theater closing down That affected my sales. I think it was like 30% downward. Okay, and that was a limiting factor. Okay, so again, similar to competitive factors, there's no equation or there's no calculation that you can do to show the exact impact on your sales. But knowing some of these limiting and competitive factors will give you a general indication of whether your sales are going to go up or down. So while we've taken into consideration, while we have to take into consideration these, four factors here, we need to calculate what our sales forecast is going to be first, and then change it based on these four things. So sales forecasting continued. Sales forecasting, again, at this point, you should be realizing that it's extremely important and dictates a lot of costs within food service and restaurants. So we forecast our sales first. Restaurants that have been in operation for a couple of years will have historical information and trend or index information to base their sales forecast on. But if you're starting up a restaurant or even just a new business in general within food service, you can use the following equation to forecast your meal period sales. Okay, and when I say meal period, I mean lunch is a meal period, dinner is a meal period. Different different times of service. Okay, so lunch, so breakfast, lunch, dinner, late night are all different meal periods. Okay, and in a lot of cases, the reason why these are different meal periods is because there's a different average check per meal period. Okay. So how we calculate this, and if I'm being honest with you, this is extremely important to your assignment, is you take the number of seats in the restaurant, okay, you multiply it by the seat turnover for that particular meal period. So how many times you think the dining room and bar is going to fill up to 100%? How many times do you think it's going to fill up and be resat? 100%. 100%. Okay. Typically at lunch, we see seat turnover of anywhere from 0.8 to 1. So that means during lunch, we fill up our entire restaurant, but that's it. Okay, or we fill up 80% of our restaurant, but that's it. Whereas dinner, we have a much higher turnover. Okay, so a busy dinner will be, anywhere from 1.5 to 2 times. Okay, so that means that we've sat our entire dining room, emptied it, and then sat it again. Okay, we then multiply that by our average check per meal period. Okay, so this is our AGC, or average guest spend per meal period. And then we times it by the number of operating days in the period that we're forecasting for, right? For example, if we're doing this for a year, okay, and we're open every single day of the year, on the number of operating days would be 365. On the other hand, if we're closed for Christmas Day, it is 364. Okay, so this equation will tell you each specific meal period sales, and if you add them all up together, that is your total sales or your total food sales for that particular period. So in the next slide, I'm going to show you a table that helps you forecast these sales. All right, so here's that example I was talking about. Okay, so in this chart, we have the number of seats in the restaurant. Okay, we've got the seat turnover for each meal period, the average check, the number of days in the operating period, the food income, beverage as a percentage, like beverage sales as a percentage of food sales, our beverage income, and then we adding them all to get some totals here, here, and here. Okay, so again, how we calculate our food income is our number of seats multiplied by the seat turnover, multiplied by the average check, multiplied by the number of days in the operating period, equals our food income. Okay, and we do that for each of the meal periods. Okay, so this right here is our food income for each one of those meal periods for what I'm assuming is a year, okay, based on the number of days. And we can calculate our beverage income if we know, generally speaking, the beverage percentage of food. Okay, so that's usually given to us here, or will be given to us. Okay, and that will give us our beverage income for the year. And if we add our food income to our beverage income for each meal period, we can calculate our total sales for the year. Total sales. There we go. Now what we want to do is look at this number. In this case, our total sales is $4,813,119.95. And we want to look at that number, okay? And we want to go through the four dynamics that we went over in the previous slide. So that's economic factors, competitive factors, limiting factors, and trend information to see if this number kind of makes sense. Okay. For example, if that's what we're forecasting initially, and there's a competitor moving into the area, okay, we would then change that or adjust that sales forecast downwards, because it's not logical that our sales would be the same, especially with new competitors. If we knew that our sales were, if there was going to be, in my case, the theater going out of business, again, we'd have to adjust it downward, right? We also have to look at the, any limiting factors. Well, that was a limiting factor. We could look at trend information to make sure that this is, if we're usually seeing a 10% year-over-year increase, and it does not represent a 10% year-over-year increase, then we could increase it to make it more accurate. Okay. So this is a good way to forecast your sales based on menu period, your average check, and the seat turnover. Okay. But again, it needs to be adjusted for things that are going on inside the competitive environment, but also within, the economic environment as well. Okay, so now that we've forecasted sales, it's come time to forecast some costs. Okay, so if we think about the two kinds of costs that we're going to have, one is variable and the other one's fixed. In food service, most of our costs are variable, which is actually kind of a blessing in this case, because for budgeting, what we can do is forecast our variable costs based on a cost percentage. Okay, so if we know that, our average standard food cost is 30%, we can multiply the sales by the cost percentage in order to get the anticipated or estimated cost based on that sales level. Okay, so it's pretty straightforward. You're just multiplying the cost percentages by the sales figure or the sales forecast. However, in some cases, forecasting undistributed or fixed costs can be a bit more tricky because they're not necessarily related to sales activities. Okay, so to control these, we employ what we call zero-based budgeting. Zero-based budgeting is very simply the idea that we cannot budget a fixed or a fixed cost, unless we have a justification for it in advance. Okay, it's the difference between rent and what would be maintenance, right? If we obviously have a justification for rent, so we can budget for our rent, but for repairs and maintenance, if we have no reason to be budgeting for that, then for example, if we're in a new building, we may not need to budget for any repairs for that year. So because we don't have a justification for that cost, we wouldn't include it in our budget. So zero-based budgeting continued. While some fixed costs are fairly straightforward and you can justify them quite well, here are some typical expenses that require the use of zero-based budgeting. For example, administration expenses, right? We have to understand what kind of benefit our organization is getting from those administration expenses, right? If there's no benefit from our, incurring an administration expense, then we would get rid of it, okay, or not budget for it. Same thing with marketing, okay? If our marketing is not going to produce us a beneficial return on investment or a return on marketing funds, then we wouldn't budget for it, right? But if we could, if our return on advertising is going to be around 20%, then that can be budgeted for because there's a justification for it, right? We also have property operation and maintenance. That was my example from the previous slide. If we can't justify it, like if we don't need it, we don't budget, right? Utilities as well. right? While there's, this can be almost, a semi-variable cost. Um, if we're not going to be using, for example, in some leases, water's included in the I forget what it's called. But if you don't have a water expense, or sorry, if you're not if water is included in the cost of your rent or your lease, then you don't need to budget for it because there's no justification for that cost, right? In doing or performing zero-based budgeting, again, the point of it is to identify a justification for that particular expense that you're budgeting for. And to do that, you might not have all the information, so you need to work with the management team in order to identify whether there's a justifiable reason why this cost should or should not be incurred. Another example of zero-based budgeting is times where we know that the sales forecast is going to be going down, right? So we're not going to be as busy or as profitable for a particular year, okay, which happens sometimes. What about bonuses, right? If we know that our restaurant is not going to be making as much money, can we justify the bonuses? And I suppose that's a question for everybody. You know what I mean? Like in some cases, I could justify it for employee morale, but I mean, if including that cost is going to put the restaurant into a loss, so a negative profit, you can't justify that cost, so you would not budget for it. Okay, so there are different examples, and it's really subjective based on you as a business owner and also your management team. But you need to engage in that conversation to truly understand whether budgeting for a cost is justifiable or not. Okay, so this is some of the information we're going to be working with on Thursday to actually put together a budget. Okay, so we have to forecast our sales. Okay, we're going to know what our cost percentages are, which is great. So most of our fixed costs are going to be shown and are known. However, there are some undistributed costs that we need to perform zero-based budgeting on. For example, in this, industry averages show that we should be allocating 5.15% of total sales on repairs and administration. Well, repairs only amount for 2% of that total. What if this is, we're starting up a restaurant, let's say it's a new building, of this information, what can we justify, right? Furthermore, our marketing expense of $40,000 produces a 20% ROI. So is this justified or not? So we're going to be creating a budget based on this information. To show you that that's possible, I've included an example on the next slide. So here's that budget that I was talking about, or the example of the budget. Okay, I've created this from the information on the previous slide, and this is essentially our budget. Okay, so now we've got a budget in this case for 2018. But how do you use this? Okay, so this is our financial plan. Okay, you can now break this down into a monthly budget, a weekly budget, and even a daily budget. Okay, that takes a bit more math, but here is our master comprehensive budget. Okay, now there's another thing that we have to do in order to achieve our net income, or our goal right here of 520,000. Okay, what we need to do is compare. We need to compare what? Actual results versus budgeted results. Okay, to see if we're on track with achieving our financial goal, and if not, what can we do to possibly get more in line with budget and achieve our goal. So here's where we're going to start to compare actual versus budgeted results. Okay, so after a time period has passed, this could be a week, a month, a year. We need to compare the actual results with our budgeted results. So this is comparing an actual income statement to the budget, which looks like an income statement. Okay, there's two ways we can analyze the differences between what's actually happened in our budget. The first of which is to do a comparative horizontal analysis of the two. So you're calculating the dollar difference as well as the percentage difference. Okay. However, this approach does have some limitations because it doesn't get into the nitty-gritty of what made the numbers what they are. Okay. For example, if we truly understand our sales are calculated by can be calculated by taking the number of guests served multiplied by our average guest check. okay? If our sales is a function of our number of guests served and our average guest check, okay, a horizontal analysis will show that, could show that, there is a significant difference between what's actually happened and what we and our budget, right? But it doesn't tell us what has happened. If you can calculate variances, which what we're going to talk about the next slide, it will tell you whether it's your guest counts that have negatively affected your sales, or whether it's the average guest check. With this information, you can start to plan ways to improve your sales by either increasing to some degree your guest counts or somehow increasing your average guest check. All right, so here's just a quick example of the horizontal analysis. Okay, so on the left-hand side here, we have the actual results, and then on the right-hand side, we have the budget. We have cost percentages for the actual, and we have cost percentages for our budget. Okay, we calculate horizontally the difference between what has actually happened and what our budget said, or what it will go. So let's look at our total sales here. Okay, so we actually sold 7,300, and we thought we were going to sell 12,600. We know that we missed our budgeted amount by $5,256. But why, right? Again, the limitation of doing this is you don't know the nitty-gritty. Okay, so you don't know exactly why your sales are decreasing, right? Obviously, this could be due to poor budgeting, but what else has happened that has contributed to this negative result? And that's what we're going to show you in the next slide with respect to variances. Another way to compare our actual performance with our budgeted performance is to calculate what we call a variance. Okay, the variance is essentially the difference between the budget and the actual results. However, they're calculated in different kinds of variances for the same line item, which I'll show you in the next slide. Typically, variance is the dollar difference between the actual and budgeted results, but it can also be the variance between guests served and budgeted guest counts, budgeted average guest check and actual average guest check. So it's really just the difference between two things. Okay, we analyze this budget we analyzed the budget and the actual results by comparing volume and the price variances, and we have to and in doing that, the difference, if there's a big difference, for example, if our actual results were not the same as our budgeted results, in fact, if they were lower, this would be an unfavorable variance. However, if our actual results were better than our budgeted results, it would be a favorable variance. Okay, the degree to which a variance is favorable or unfavorable depends on how it kind of impacts operating income. Okay, so obviously, an actual average guest check being higher than the budgeted average guest check, because that increases operating income and profit to some degree, this is a favorable variance. However, if actual guest counts were lower than budgeted guest counts, this is unfavorable because less guests are most likely going to have a negative impact on our operating income. So in the next few slides, I'm going to show you how to calculate sales and cost variances based on price and volume variances. So here's where we're going to calculate some sales variances. Okay, sales variances are composed of two things. Okay, both a price and volume variance, and these because these items, volume, which is guest counts, and price, which is our average guest check, both determine what our sales are. Because again, sales can also be calculated by taking the number of guests served multiplied by an average guest check. Okay, so here we need three pieces of information. We need one, our sales. Okay, so actual sales, budgeted sales. We need the number of guests served, and we need our average guest check. Okay, this can be calculated fairly easily by taking your sales, dividing it by the number of guests served, and that will give you your average guest check. Okay. Vice versa, your number of guests multiplied by your average guest check will give you your sales. So we have these three items, and we have our actual results, so what actually happened, and our budgeted, what we thought was going to happen. Our volume variance, so this is where we're calculating our several different components of variances. Our volume variance is the degree to which our guest counts differed from our budget. Okay, so if we take 5,000 minus 4,500, okay, that's a $500 difference, but it's going down. So our actual results are lower than our budget. So there is a $500 variance because there's a $500 difference. Now, because less guests is poor or has a negative effect on our operating income, this is an unfavorable variance, okay? Because we thought we were going to serve more and we actually served less, okay? Our price variance refers to our average guest check, or the difference in our average guest check, okay? You'll notice here that 15.15 minus 15 is 0.5. And you'll notice that our actual result was higher than our budgeted result. So this variance, 0.5, is favorable because customers paying higher prices is good for operating income. So our price variance in this case is 0.5 because there's a 50 cents difference between the two. And this is favorable, okay? And then we calculate our sales variance. So we take in this case, our budgeted sales were higher than our actual. So we take our budgeted results, subtract our actual results. And in this case, we get $5,250. However, our actual result was lower than our budgeted result, and lower sales has a negative impact on operating income. So this is an unfavorable variance of $5,250. So how do we use this? Well, first and foremost, we can tell based on our variance here, or our sales variance, that we have, our sales have gone down or are $5,250 less than what we were budgeting for, okay? So this is not good, obviously. Our sales are not as high as what we thought they were going to be, but why are they? Why is this an unfavorable result? So to answer that question, we look at the volume and the price variance. Okay, so for example, our price variance was favorable. Okay, so this is a good thing, right? Our customers are paying higher prices. Where the problem is with our sales is the volume variance, because there is a 500 guest unfavorable variance. So when asked why our sales are lower than the budget, we can say it's not because of our average guest check. Okay, so our average guest check is higher than it was supposed to be. The reason our sales are lower than budget is because we served 500 less guests. And we know this because our volume variance is 500 guests in an unfavorable manner. So as you can tell, I mean, doing a horizontal analysis of your sales, it will show you the sales variance to some degree, but it does not go into a deeper dive into your price or sales variance. You can only do that by manually calculating the variance and determining whether that variance is favorable or unfavorable. And these things will tell you how to improve in this case, your sales for next time. For example, you have to try to increase your guest counts, and you don't need to do anything about your price or your average guest check. While we did this for our sales variance, we can also do this for our costs, and that's what we're going to go over in the next slide. So our cost variances. So our sales variances and our cost variances are very similar in a few ways. Firstly, our cost variance is based is the cumulative effect or composure of our volume and price variance, very similar to sales variances. However, in this case, we're talking about a cost and not sales, right? For example, with respect to sales, more sales is a good thing, or increased sales is a good thing, right? Whereas a cost, an increase in the cost is not necessarily a good thing. Okay, so here we're looking at the same variances-ish, except under the context that this is a cost, not sales. Okay, so here we have some cost information for our budgeted and actual results. Okay, we have one, our total wage cost. We have 2, our average wage cost per guest. And then we have 3, the hours used. Okay, so this is the number of labor hours used. Our cost variance here is just taking our budget and subtracting our actual result because our budget is higher. Okay, and the difference in this case is $1,450, but because the cost has gone down in comparison to budget, this is a favorable variance. Okay, again, because cost going down has a positive impact on operating income, or at least we would think it would, so this is favorable, right? But if we look at the cost per guest, okay, so in this case we're taking the actual result because it was higher than the budget and subtracting the budget, we get a 0.5 variance. Okay, so there's a 50 cents difference between what we thought it was going to cost us and what it actually did. Okay, because the average cost is going up when compared to budget, this is an unfavorable variance because more cost has a negative impact on operating income. Okay, however, if we look at the volume variance, okay, so this is our hours used. Okay, so we're subtracting the budget from our actual because the budget is higher. We get a $250 difference, and because we're using less hours than we budgeted for, okay, and assuming that an hour used has a cost to it, reducing the amount of hours used to budget is a favorable variance. Okay, so in this case, obviously we have a favorable cost variance for our wages, or our wage cost, and it was essentially the volume of the favorable volume variance within this cost that made a difference and made this $1,450 favorable variance happen. Okay, because this is a favorable, an overall favorable cost variance. There's not much we have to do here. In fact, the price variance of your average cost per guest, this can be directly influenced by your hourly wages. Okay, so if minimum wages if they went up, that would explain this price variance. But it also could depend on who's working. For example, not everybody in the kitchen makes the same amount of money. In some cases, it will cost you more to have certain people on the line. Okay, and same with the dining room. Okay, so again, very similar. Cost variances are very similar to sales variances in that we look at the total variance, whether it be cost or sales variance, and then examine that variance in deeper detail by looking at the contributing factors that created it. In this case, in both cases, is composed of a volume and a price variance. And that will give us an indication of what has created the overall variance and what we need to improve on to make our actual results better in the future. Okay, so there's some other ways to forecast your sales. I mean, we showed you one today, okay, by calculating your sales by meal period and then adding it up for your total sales, which is dependent on the amount of seats in the restaurant, your average guest check, and the hypothetical turnover for each meal period. Let's say we did have some, multiple. If we had historical sales information, we could also forecast your sales in other ways. For example, moving averages. Okay, where we're calculating an average, based on the most recent sales information. Okay, whereby discarding the last period because it's a moving average. Or again, we could do a regression analysis. In our case, a seasonal regression analysis. Okay, so in the next 2 slides, I'm going to show you how to calculate a moving average. Okay, we're going to practice that on Thursday. I'm going to give you a detail about the regression analysis. However, we're going to be performing that because it's easier to understand how to do a regression analysis and forecast sales by just doing it. So I'm going to explain what it is, how we can use it, but we're actually going to do one on Thursday. So moving averages. A moving average is an average of changing periods while the number of the terms used in calculating the average stays the same. Okay, so How we calculate that is the sum of the n periods. Okay, so let's say we're doing a 3-month rolling or moving average. We add up the sum of the 3 most current periods and then divide it by the 3 periods. Okay, as a new period becomes available, we add that new period into the average and subtract or leave out the latest one, or the one that is uh, the 4th period away from the current period. Okay, and in doing that, you're taking into consideration only the most current information in calculating your sales. However, there are a severe amount of limitations in using moving averages. One of those is, restaurants or most food service businesses, we have seasonalities. Okay, and if we're not taking into consideration that seasonality, which just says that our sales are not consistent every single month, then we're forecasting incorrectly. Okay, this is also it's a moving average. It's just a simple average, right? It's not weighted. It's just a simple average, and as a result, it doesn't give us a picture of the competitive environment, or other things. It's just a simple average. So this can be used, however, it's not terribly effective. In fact, based on experience, the equation that I had showed you earlier with respect to meal period sales is a lot more accurate than the moving average, and so is regression analysis, which is what we're going to talk about next. All right, so regression analysis. We've already kind of talked about this a little bit with respect to separating semi-variable and total costs into fixed and variable components. We can also do a regression analysis on historical sales information. We will be using Excel to do this. Based on our previous example, when we calculated the regression, we can add a trend line, and then we can also forecast periods forward or backwards. Okay. However, the regression analysis we did was called the least of squares, or partial least squares regressional analysis. What we're going to be doing on Thursday is we're going to be doing a seasonal regression analysis, which takes into consideration the ups and downs in our sales levels. For example, if here's the different months of the year, okay, and here are sales, right? It's a lot easier to forecast sales that do this all the way throughout the year, right? However, we know that in our industry, sales per month do kind of one of these, right? So there's a seasonality. Seasonality. There's a seasonality component to our sales, where in some cases, in some months, there's a big dip. Okay, only a seasonal regression analysis will take this dip into consideration when forecasting next year's dip. Okay, so that's what we're going to be doing on Thursday. Okay, we're also going to be talking a little bit about cash flow statements and how to create them. Okay, and that's it for this video. Okay, so the main things that I wanted you to get from this particular video was the different kinds of budgets that we use as good practice in food service, the different ways you can forecast sales and costs, okay, and create a budget based on those things, and then how to compare actual and budgeted results in performing both a horizontal analysis and a variance analysis to understand why there are differences between our actual results and our budgeted results. Okay, so thank you for watching this video, and we'll see you on Thursday.